Hello, everyone. We'll just give it a minute for people to join. Great. I see quite a few people trickling through, and maybe I will just kick off this session with a few welcome remarks. So good morning, good afternoon, or good evening, depending on where you're joining this webinar from today. I am Anjali Vishwamohanan, Director of Policy with the Asia Investor Group on Climate Change. And it is really a tremendous pleasure for us to co-host this webinar today on investing in climate adaptation and resilience in collaboration with the Cambridge Institute for Sustainable Leadership. For those of you that are not aware, AIGCC, the Asia Investor Group on Climate Change, is an investor network that brings together financial institutions, both global and domestic, that have exposure to Asian markets. And we work with the investors that are part of AIGCC to really try and understand and integrate climate-related risks and opportunities as they would manifest across Asian markets. So we deep dive into multiple climate themes, including themes of energy transition, physical climate risks and resilience, forests and land use, the social elements of transition, and sort of multiple other themes for investors to develop thought leadership and approaches on how private finance can take more of a leadership role in addressing some of these risks and seizing the opportunities as well. And the ultimate objective that we have at AIGCC is to develop net zero aligned, resilient economies that are nature positive and are ready for the changing world that we live in at the moment. And I think the mission that we have at AIGCC is quite aligned with CISL's mission as well. So I think which is why it is a great partnership that we have and for us to be co-hosting this webinar. And the topic of investing in adaptation and resilience is a theme that both organizations have done significant amounts of work on. But more recently, we have both published complementary reports on the topic of how private finance can play a bigger role on adaptation and resilience, which is what we will be sharing over the course of the conversation. Can we shift to the next slide, please? I just want to take everyone through the agenda for this 1 hour that you will be spending with us today. It will be structured with opening remarks from Motsomi, who's kindly agreed to join us from the UNFCCC Secretariat to sort of really set the scene for the discussion that we have today. And then we'll have Trisha from the Cambridge Institute to sort of really give us key highlights from the report that they've put out recently. And then I will do the same for AIGCC's report on adaptation plans in Asian markets. And then we have a great set of panelists from the financial sector, but also from the CSO community that's been doing years of work in this space to sort of share their practical perspectives on these challenges and also approaches that we are seeing in the markets that are working, which will be moderated by both Trisha and I. And I think just to note that over the course of this conversation, we are quite keen to hear from the audience as well. So there's a Q&A function that's at the bottom of your Zoom app, which will remain open over the whole discussion. So please feel free to drop in questions over the course of the conversation so we can try and weave that into the panel discussion that we have towards the end. And we will do our best to try and address most questions. So I think we have quite a lot to cover and it is an exciting agenda. So without further ado, can I invite Motsomi Maletjane from the NAP unit within the Adaptation Division at the UNFCCC Secretariat to give us the opening remarks. Thank you.
Thank you very much, Anjali, and indeed, good morning, good evening to everybody that's in the webinar, depending on where you are. First of all, let me express my appreciation to you, Anjali, and to the CISL for inviting us to this important webinar to speak about our work on adaptation at the UNFCCC, which of course largely relies on the contribution of many actors. And I feel very privileged that today I'm in this audience, which has a diversity of audience from governments and I know also from the private companies, and this is very privileged opportunity for us. So in going straight into what I would like to introduce this morning, I have 5 key points that I would like to highlight. The first one, I will talk about the agency of adaptation in investment decision making. Why is it important? Why do we consider that to be important? I'll go deeper into what we call national adaptation plans. I'll speak a little bit about that and their role in the topic or context that we are speaking today. And provide some examples that we already see on how governments are engaging the private sector or envision the engagement of the private sector in their work on climate change adaptation, and a little bit of what we see as the private sector can do to support NAPS more proactively. And my last point, I will talk about some of the immediate opportunities, or at least some of the initiatives that we have launched that we see hold greater potential for engagement. So going back to my first point on the agency of adaptation, investing in adaptation decision making. Adaptation or climate change adaptation, I think is a topic that for many years it has been not so much in the view, or at least in the space of the private companies or the private sector. And you all know in the perception that maybe the returns are not as immediate and you don't see them. But I think the focus has largely been addressing climate change mitigation. But there is a huge potential in looking at adaptation in itself. But it's an opportunity. Actually, we look at adaptation more as investing is not just about the cost, but an opportunity to build resilience and thriving societies and economies. Because the cost of inaction at the end of the day becomes greater. And also adaptation can be, of course, an opportunity for thriving businesses and industry in the industry. Another thing that is important to note, I think, in adaptation as well, is that the cost of adaptation is big. I think it costs everybody from the private markets to the governments or public entities, but the cost is large. Currently, we are looking at up to close to 400 billion per year that's required for investing in climate change adaptation. But the available public finance space only is able to provide approximately about 30 billion of that. So you can see that's a very small fraction on what is needed vis-a-vis what is available. And these are the latest estimates that we have, for instance, from the UNEP Adaptation Gap Report, for instance. So it means that there's a huge potential in filling the gap in investing in climate change adaptation. We are talking a lot now about how do we promote innovative sources and modalities of finance that go beyond, because for now, adaptation is financed primarily through public financing, the taxpayers' money primarily. So we are trying to find ways on how can we find other ways of generating money for adaptation that is not going to increase the tax burden, that is not going to increase the debt burden of all the players that are concerned. And I will also go a little bit more about that. So now into what is the National Adaptation Plan. I mentioned that I'll speak about the National Adaptation Plans. They are the resilience building instrument under the UNFCCC. These were launched in 2010. It's an instrument that enables governments to articulate what their climate risks are, looking at the whole landscape, whether it's the risks in food, the risks in health, the risks in ecosystems, the risks in business and industries. And some governments are actually now proactively also asking the business industry to do a risk screening of their portfolio to see what are the risks associated with that, so that we don't have a collapse of the supply chains in case any climate risks occur or happen. And that is increasing. And I think that is the element that we want to see growing, because I think the private businesses and the private sector are the pillars of the economy. And if we have collapse in that, then we have a problem. So the National Adaptation Plan serves as an umbrella for an adaptation to articulate its risks in terms of how it will build resilience. The intention is also to convene multiple stakeholders. So the government, the non-government entities, the young people, everybody, all the societies that is in the country, to convene them together. That is why the adaptation plans or national adaptation plans then become an important instrument as well, as a starting point or entry point, even for the private companies to look at it and see how can we contribute. And if you wanted to contribute, I think that would be a very good starting point. It is also evidence-based, because I think the NAPS, they follow a systematic methodology. We have the guidelines that are agreed by all the governments. Under the UNFCCC, now we have 197 parties, and they all come together and agree on the guidelines on how should a NAP or an adaptation plan be prepared. And there's a lot of good practice that's being followed there. They contain the information in terms of the climate risk, and then some innovation and technology, as well as what adaptation actions need to be implemented. And they have a long-term policy direction in them for climate risk assessments and investments. And a lot of them also talk about innovations and technologies, but we all know that that would only come from the private sector as well, or the private companies, the private industry, if we talk about innovations, whether it's in technology or it's anything. In terms of the picture, if you want to get a picture in terms of where are these national adaptation plans and how many do we have? Currently, across the world, we have 63 developing countries or in the emerging markets that have developed what we call these national adaptation plans. And coming to the Asian region as well itself, quite a good number, or nearly half of the countries in the Asia-Pacific region have prepared their national adaptation plans, but there's still a big scope for a lot more countries to prepare their national adaptation plans. Here, those that have NAPs in the region, we're talking about countries like Armenia, Azerbaijan, Bangladesh, Bhutan, Cambodia, Fiji. If we go to the Pacific, then Kiribati, the Marshall Islands. But also we have, of course, bigger countries, the Pakistan, the Philippines, Thailand, Sri Lanka, that have really gone forward and prepared their national adaptation plans. I talk about Mongolia, Kuwait. So there's a good mix of countries that have already in place their national adaptation plans, which provides an opportunity already to start engaging with these countries, or at least start to motivate the private sector in these countries on how best to engage and work with the governments together. And I will also talk about, I mean, it's not only assisting where there are national adaptation plans in place already, but also it's also how to help the governments also prepare these plans in ways that are better informed for climate decision making. Some examples in terms of how the governments envision engaging the private sector, for instance, if we will take the case of Bangladesh, as I did mention, they have a national adaptation plan, for instance. They have engaged the private sector in preparing their national adaptation plan. And the private sector contributed in informing the government that how do we see the private sector engaging? And some of the intervention areas are in flood management through submergible dikes, in agriculture and food security. And I think, Anjali, you talked about the report you produced, and I think agriculture and food security also features one of the entry points and potential areas where the investments are easily and can easily be tapped into, in drought-resistant crops, in floating bed cultivation, etc. And also in the climate disaster management through building shelters, climate-proofing infrastructure. So we see cases where the private sector is already helping government with concrete ideas on what investments would be possible for the private sector to engage. In Fiji, for instance, the private sector provided data on climate risks to operations, which shaped the adaptation priorities of the country. In fact, the Fiji Development Bank began starting to explore what are adaptation-aligned lending. So lending that is aligned to the climate risks. And many of you would already be aware that across the world now, the financing industry is starting to be more cautious about where to invest the money. If there are higher climate risks, it's either you get lending at a higher interest rate or you don't get lending at all. And these decisions are already happening in many markets. And I think that's an important development as well. There are many examples. For instance, in Thailand, the government encouraged the private sector to play an active role in managing climate risks by supporting climate insurance businesses and also offering financial incentives such as low interest loans or tax exemptions for climate adaptation projects. So we already see also governments also trying to lay the foundation on how they see the private sector engaging better. There are a lot more examples that we can pick from these countries. And of course, I can invite you as well to look at the national adaptation plans of these countries that already have national adaptation plans. I will share my information with Anjali. Of course, you can share with the others to see which countries do have national adaptation plans that then you can start to explore. But then going deeper then in terms of how do we see the investors then investing in adaptation? The investors, or at least the private investors, you can look at how can you implement the adaptation measures that are meant to protect the assets and operations in a country, whether the assets, as I said, they could be in health, or they could be in food, they could be in water ecosystems, or broadly in infrastructure of the country. So companies will be more competitive, of course, if they are resilient to climate shocks. So the private sector can implement adaptation actions in order to protect its own operations. So it's not only actually giving necessarily to the government, but also looking at your own supply chain as a private company to see from sourcing, from raw materials where you get them to processing, etc., the whole supply and value chain. Where do you see the most risks, and how can you climate proof that? I always make examples, and I can say, if there's no Panado in the market, the citizens look at the government and say, where's the Panado? But it's the private sector that actually makes the Panado. So how do we make sure that the supply chain of the painkiller that you need is available and is not disrupted should there be any climate risks, and working together with the government? The private sector can also contribute to the formulation of the national adaptation plans that I mentioned. A lot of these require sophisticated data and analysis models, and many of the private sector actually already own this. For instance, the companies that are courier companies, or at least that deal with the logistics, know very well the track of storms and when they are coming, so that they can plan their routes very well. And this information also, we find that even they are doing it better than the governments. But if we can work with the governments and feed them this information, then that also, that complementarity and working together with the governments, feeding them this information. So all these big companies, they have data that you collect either through satellites, through your own networking systems, and it also helps governments as well in terms of how they can build better and well-informed assessments. And also the private sector can look at the NAPs, or at least the national adaptation plans, and look at the adaptation priorities that the government identifies, and look at which ones would be more attractive to the private sector. Where can you invest? And many of them, of course, they can easily generate return on investment. That as a private company or as a private entity, you can see how you can also invest in those to get revenue. As I mentioned, there is the technology as well, there's innovations as well. And also the private sector can also participate with the private banks in terms of creating climate funds. On how do we do that? So in terms of some of the opportunities that I was talking about, I said that we have some initiatives that we have launched that provide a lot of initiatives. The big one that we have that is being championed and run by our executive secretary, he launched what we call the NAP 3.0 initiative. The backdrop to this, as I started with my talk, I was saying that we have a huge need for investments in adaptation, but the available public finance that's flowing, it's much, much less. How do we close this gap? Even if we were to run our model of public finance at 100% efficiency, we will not close the gap that I said we need 400 and we only can mobilize 30 billion now. From 30 to 400 is not something that we can see a jump even in the next 5 years. It's not something that we can judge even if we can fix the efficiency of our system. But how do we generate that new money? And I think that's where the private sector, not only the private sector, everybody else, philanthropies, and even the citizens themselves, it's how do we come together to create business models that will multiply or regenerate or create new money for adaptation. So we are looking at generating new money that is beyond the ones that we know. And how can we do that? And we are trying to involve the people that work with money more than us, because some of us, myself personally, I don't work with money. But of course, a lot of the private entities, and thanks Anjali in this group, and certainly sure that there are people that work with money. We need your advice on what are the best ways that we can generate new money for climate change adaptation that governments can use, that can generate money domestically or even globally or even at the regional level. So it's launched that initiative, and we are engaging a lot of thought leaders in this process to help us with this thinking. And if you have any ideas, very much open to that, and we'll very highly appreciate that support. It has other pillars. One of the pillars then is finance, but the other pillars are about the guidelines in terms of how do we provide the best technical expertise or advice to the countries to prepare their plans. How does everybody have a plan and capacity building for building projects?
Fantastic, Motsomi. I think that's been very insightful, and I think it really sort of sets the right context for discussions, because I think the point that you sort of ended on the need for finance, the private finance sector to innovate and contribute to this process is exactly what we're going to sort of get into in the next segments. And I think over the course of the panel discussion, it would be fantastic to sort of hear from you on more examples from what you're seeing in market. I think the Bangladesh, the Fiji, and Thailand examples were fantastic, and would be keen to hear more. But I think for now, let me pass on to Trisha from CISL, who would be presenting on their report on looking at resilient investment portfolios.
Thank you, Anjali. And hi, everyone. I'm Trisha. I work with the University of Cambridge Institute for Sustainability Leadership, and I'm here to present our latest research on investing in adaptation and resilience. So the report that we've published is essentially designed to help investors manage both physical climate risks within their portfolios and also contribute to systemic resilience across the wider investment ecosystem. And so the central idea is to begin incorporating climate risk assessments at the start of the investment process so that these can be trickled into later stages of the investment process and can help build portfolio resilience through your investment portfolios. But also the guide is designed to help investors understand how best to engage with the enabling ecosystem. So with corporates, with the broader finance sector, and with policy in terms of how to build systemic resilience and create an ecosystem that enables investments into adaptation. If we move to the next slide, please. So when we think about why this matters, we see that physical climate risks are accelerating. However, current investment frameworks still don't adequately account for them or reflect them. And so when we look at the market perspective, we see challenges where a lot of the current assessments focus more on real assets, and we have a lot of fragmented approaches that fail to capture the real systemic exposure of climate risks. What we hear back from investors that we work with are many sort of recurring challenges around the need for clearer definitions and standards, the challenge of different time horizons, so sort of short-term investment portfolios and long-term climate risks, and also the gaps in data, so the need for actionable forward-looking risk information. And so it's within this context that we developed the guide, which is essentially to help investors cut through the noise and move from awareness and acknowledgement of risks towards action. If we can move to the next slide. And so the guide essentially looks at two things. It looks at the investment process, where we see that early investment decisions shape not just asset level exposures, but also the trajectory of the entire portfolio. So this section offers a step-by-step view of how to integrate physical climate risks into each stage of the investment process, from setting climate-aware objectives, integrating climate risks into economic forecasts to help support asset allocation decisions, quantifying climate risks in the due diligence stage, selecting adaptation and resilience aligned investments, and engaging with portfolio companies. So how can investors move from mere risk management to impact measurement on an adaptation and resilience scale? And the key message here is that physical climate risks must be addressed at the start of the investment process. So by acknowledging and assessing these risks at the beginning, we can help address them later on in the investment process itself and help investment portfolios become more climate resilient in the future. If we move to the next slide. So beyond the portfolio level changes, the guide also highlights the importance of engaging with the enabling environment. So regulators, corporates, policymakers, data providers. It essentially calls for greater investor involvement in helping shape the landscape for adaptation and resilience. So detailed here, we outline examples of what engagement could look like across these different platforms. So when we look at policy, we look at how investors can engage with national adaptation plans and NDCs. We also look at blended finance structures and how investors can leverage learnings from the insurance industry, which has been looking and modeling at sort of long-term climate risks for already a while now. We also look at corporate disclosure frameworks and how these can be enhanced to better support informed decision-making. And we also look at the internal capacity building and education that's required to bring practitioners in the field, but also clients along the same journey of understanding the financial materiality of climate risks. If we move to the last slide. And so the main takeaways from this research are essentially highlighting the systemic nature of physical climate risks. So climate risks are systemic, and so addressing it requires a systemic investment approach. And so the guide outlines clear, actionable steps for investors to both assess and address climate risks, both within their portfolios and then within the broader ecosystem. So a few core ideas that we've pulled out in this research is the challenge of fragmentation. So investor current approaches to climate risk assessments are still siloed and inconsistent. So there is a need to kind of unify and have a sort of a clear understanding of climate risk assessments from an investor perspective and also from a financial materiality perspective. There's also an opportunity to leverage learnings from the insurance sector. The need for data is crucial. So accessible, decision useful data is essential. And this challenge of balancing short-term returns with long-term resilience requires a play in the sort of time management and modeling aspect of climate risks, recognizing that a lot of the climate risks, which were perceived to be long-term risks, are now increasingly more evident in the short term as well. And so the research we've put out seeks to reframe adaptation not only as necessary, but also as an investable opportunity. And so it's focused on protecting investment portfolios, but also helping shape a financial system that can withstand what is coming up in terms of the increasing impacts of climate change. And so through opportunities like this, we're eager to build momentum around the critical discussion of adaptation and resilience, as collective action will be necessary to drive change at the scale that is required.
Fantastic.
Thank you, Anjali.
Thank you for Trisha. I will now spend and struggle to sort of limit my presentation to 5 minutes, but I think it's sort of quite sequential, sort of drawing on one of the recommendations from the CISL report for really the collective action that's required from investors to increase the ambition of the national adaptation plans is really what our report focuses on. So I think just to give you a bit of a context on why we thought this work is sort of quite important, because at AIGCC, we've had a working group on physical risk and resilience for 5 years now, which is chaired by Eric, who's going to join us quite shortly. And so one aspect of, when we started this work, we really wanted investors that are invested in Asian markets to have a clear understanding of the risk exposure of their assets and portfolios in Asian markets on climate risks. So we looked at the service providers and tools that are available in the market to sort of create that data platform. And then we sort of used that data to actually engage with companies to understand how much of this risk alignment sort of exists between businesses and investors, and how are companies really using this information to develop resilience plans, but also start allocating capital towards building resilience for their own assets. But we also, in the process, realized, like as Motsomi said, that companies' operations are dependent on supply chains and other factors that is oftentimes out of their control, like critical infrastructure that businesses depend on. So you need to sort of really think about a coordinated response on adaptation at a national or local level that businesses can feed into to sort of firstly ensure that the business resilience exists, and then you also want to ensure factors that oftentimes are maybe not in the business domain. So like looking at the social impacts of physical risks and adaptation measures is quite important to prevent negative impacts that could arise from adaptation responses as well. So we sort of looked at the policy approaches that are prevalent across Asian markets. And as Motsomi said, we found that the National Adaptation Plan process was really comprehensive in looking at like a long-term horizon and trying to understand the climate risk impacts in the market, and then really work together with collaborative stakeholders across businesses, investors, and communities to develop solutions that should be implemented in that market, factoring in the long-term risks. It also, I think, looks at integrating adaptation with the National Development Plan, which we think is quite crucial to enable interministerial coordination that would enable better budgeting, better responses. And I think it's important to also see climate from a development lens, both in terms of risks and opportunities. So I think all of these perspectives really came together well in the concept of an adaptation plan. So we started deep diving into how these plans are sort of developed in Asian markets and how it's being implemented. And I think we're seeing that there are varying stages across Asian markets on this. But I think what we also try to do is to sort of enhance the adaptation plan framework to add more elements on how these plans could enable more private sector participation. So just if we can move to the next slide. So we outlined 7 key investor expectations that would enable more private sector participation. It's largely categorized into 3 main buckets, a lot of which is on enabling that data sharing and understanding between the public and private sector. So the ones that's highlighted on 1, 2, and 4, so really outlining a consistent national view on physical climate risk is really important for investors and businesses. It is important to base business national adaptation plans on adequate scenario analysis, looking at the right time frame as well. And it is important to also supplement this national level data with bottom-up data from companies through mandatory climate disclosure in these markets. We also see that there are certain factors which sits outside of business data. Like, so for instance, when you look at inter-regional risks and transboundary risks in terms of water and supply chains, it's quite important to integrate that data in adaptation planning. And then also the impacts on the social sides, looking at vulnerable communities and ecosystems. So you're able to actually integrate all of these factors to prevent that negative impact as well. And then we've also made some suggestions on how the finance sector can get more involved through active participation, and then looking at how finance mechanisms can be structured if you're sort of able to conceptualize projects and then involve the private sector. There's a lot more detail in the report, but just next page, please. What we've done is we've assessed the adaptation plans and policies that exist across the 9 markets that are listed at the outset. And what we've done is to sort of classify how these markets are aligning with the investor expectations. So we use a traffic light signal system of green, amber, and red to sort of indicate why markets are doing quite a good job on a specific angle. So we're able to actually draw from best practices and enable other markets to move forward faster. And we've also identified amber and red by a bit more work needs to be done on that space. This is just to sort of enable investors to actually work closer with policymakers on improving those metrics as well. So just quickly, next slide, please. So this just sort of gives you a high-level overview of the in-depth assessment that we've done for each of the 7 metrics that we think is sort of quite important from an adaptation plan perspective. There's quite a lot of detail in the report on why we've given this classification, what policy it links to, and also suggestions for improvement. Next slide, please. I think just to highlight maybe a few best practices that we are seeing. So I think increasingly out of the 9 markets that we have surveyed, we see that 4 markets are actually in advanced stages of developing data platforms to really collaborate with the private sector, while the others are sort of in the process of doing that. We're also seeing collaborative investment platforms being developed by a few markets like China to actually work with investors on investment strategies. We are also seeing significant gaps, as you can see from the red. I think really where we want to sort of see more work is on the transboundary impacts, because I think there are very few case studies that we're seeing of good integration of this kind of data in adaptation planning. So there's quite a lot more to sort of do on some metrics as well. Next slide, please. So I think the takeaway from this report is, like I said, is just a tool to enable more private sector engagement with policymakers on these elements to sort of improve implementation in the market. So we have investor leads for the 9 markets that we have sort of studied in this report to actually work closer together with government on implementation and actually translating some of these plans into financing solutions as well. There's a bunch of really good case studies as well that's in there, but I hope to sort of get into some of it over the panel discussion, which we will start now. So I would like to invite the panelists to join me so we can sort of go over what we've discussed and really get practical insights from the panelists on this as well. So firstly, I'd like to introduce Eric, who's the head of Sustainable Investing Asia at Manulife Investment Management. He's also been a part of AIGCC, as I said, and we're very lucky to have him at AIGCC and also at the webinar today. Also introducing Sabrina from the Atlantic Council. I think the Atlantic Council does fantastic work in sort of developing multi-stakeholder approaches on looking at global issues on adaptation and resilience. And Sabrina has done quite a lot of work with multiple organizations in this as well, which I hope she'll highlight over the course of the conversation. We also have Erwin from PGB, Erwin is the Senior Portfolio Manager for Sustainable Investments within PGB, and he has 25 years of experience in sort of working in this space. And we'd be be privileged to sort of hear from his insights over the course of the conversation. And we also have Motsomi, who will join us as well for this discussion. I already see some really good questions actually coming in on chat, but please keep them coming as we sort of just kickstart the discussion right away. So I think maybe just to start with Eric and Erwin, I think just sort of being part of financial institutions that have prioritized the need for adaptation and for private sector to sort of get involved. Can you talk a bit more about why does the private sector need to prioritize adaptation financing, and what are the barriers that you've been seeing, and how is it sort of evolving over time as well? Would be really good to kickstart the discussion from your end. Maybe we'll start with Eric.
Sure. Thanks, Anjali, and it's a pleasure to be here. I think the obvious answer is the private sector needs to be involved because there's real kind of financial risk here that needs to be addressed. But I think also, as Motsomi touched on, the financing need for addressing that is just too big for the public sector alone. So UNEP puts the adaptation finance gap at 187 to 359 billion per year, and it's just not realistic or right to ask governments and taxpayers to cover that on their own. And on the barriers, I always say that there's two common challenges of ticket size and cash flow. So the ticket size challenge I call the barbell problem, meaning that adaptation projects are often too small or too big for common financing instruments. So for example, you could have a $10 million storm drain project or a $4 billion seawall project, but those would be too small or too big, respectively, to fit into kind of a standard $300 million public bond issuance. And then the other problem of the cash flow problem is that many of these projects are also protecting existing cash flow streams rather than creating new ones. And so that means that they need to be paired with some kind of underlying cash flow or some kind of existing business line in order to create a return for investors and banks to make them kind of bankable or financeable. And so I think if we can start solving these two problems of ticket size and cash flow, then we can really open up a lot more adaptation finance.
Fantastic. Very actionable insights already. But Erwin, did you want to come in here?
Yep. Hi, good morning, and really delighted to be here. Thanks. So I'm actually working for a Dutch pension fund, and so we're basically not a charity. So every time we're looking at investments, we'll be looking at profitability, we'll be looking at financial return and risks, and we'll be looking at sustainability aspects, right? And the latter are that's a good thing then, because everybody is getting more and more, let's say, serious about the systemic risks that we talked about in the last half an hour. So every pension fund, at least I think in the Netherlands and also in the UK, I guess, and in the Nordics, is actually looking at okay, how is climate change, how is biodiversity loss, how is health, right? And how is that going to affect actually our participants' base, and how is it going to affect also our profitability going forward? So I think that's a good thing that over the last couple of years that's become like that's not a question anymore. That's just a given. And then you start actually looking indeed at solutions. So I think what Eric just said is good. I would actually like to add perceived risk. That's a very important one, because this actually the solutions are not the problem right here, right? We got solutions. We got all kind of technology that's going to help us to kind of make that transition happen, and also adaptation kind of solutions. So that's not really the problem. Problem is how to get the money there. Perceived risk is one of them. Now the good thing there too is that a lot of research is being done and has been done over the last couple of years. So one of the great reports, I think, which is definitely going to help everybody, is the GENS report, right, which came out at the end of last year, and that actually that illustrated that the real risk that you're running on a lot of these what we then would call emerging markets, which I definitely do not like that term, but is much lower than you would expect. And at the same time, so that's one thing. So that's how to actually manage that perceived risk, and it's an important one. Storytelling. Also telling a little bit more about, and that's also a barrier, I think, an opportunity. It's storytelling. It's share more about about how things work out, what the added value is, and what you also see is basically, and that's a mindset. It's people want to know what's happening with the money, right? They're investing in. So there's a surge in impact investing. Especially, I'm not quite sure how it works all over the world, but at least in Western Europe, there's a lot of interest for impact investing, which basically where you basically say, okay, I want to know what's happening with my money, right? It has to contribute to the solution. Let's say tackling one of these SDGs. And if you look at these SDGs, you get a couple of usual suspects that pop up all the time. Right, the ones I just mentioned, right? It's climate, it's biodiversity, it's these kind of things. So there's a lot. The climate, let's say, the investment climate has changed. Then again, if you look at solutions, because I like to think in terms of solutions, right? It's you get all these let's say blended finance constructions or constructions with guarantees or whatever. These are also taking off, and that is very interesting also from an investor perspective, because you can actually kind of get rid of a little bit of the risk there, right? While the technology thing is not really an issue, because you know that's going to happen. And most of the time, if you're investing in emerging markets, you get less red tape. That's my perception. That could be wrong. And get things done much quicker than, for example, in the Netherlands, right? Although the Netherlands has a kind of an issue, I think you're kind of eager to kind of kick me out, right? I got to stop talking. But the Netherlands is kind of an interesting one, because 30% is below sea level, right? And we're at the delta of a lot of these big European rivers. So we already had some issues in the past, and we also have examples of nature-based solutions which seem to work. The only real challenge we have is lack of an adaptation plan approved by the government. So I just looked at the website of the national of the NEPs there, and I'm pretty disappointed to basically say that apparently in Western Europe there's one country which kind of committed, right? Which kind of submitted one. So that also tells a little bit about the fact that on the government side we definitely have to start pushing a little bit more than before. I rest my case.
Fantastic. I think Eric and Erwin has sort of done a good job in sort of highlighting the hurdles that we're seeing from the private sector perspective. I'll be keen to sort of draw in Sabrina now to sort of really talk about the policy shifts that are required to attract capital, and some of the work that you've been doing on effective engagement ways as well for investors to engage with policymakers to sort of translate some of these problems that you're seeing to solutions, so you can actually contribute to adaptation finance as well.
Thank you so much, Anjali and Trisha. You're both leaders in the field, and thank you for your amazing work. I'm honored to be here. I quickly want to get back to the barriers point, because I've been speaking about barriers for the past 5 years, and I'm going to share a very unpopular opinion. Oftentimes, they're mentioned as excuses, and I've seen small financial institutions in emerging markets doing incredible work on adaptation and resilience, even though they have many more barriers than institutional investors in developed countries. So what I actually think the underlying barrier is the lack of coordination and collaboration within the financial system. So also with institutional investors and insurers, banks and insurance, etc., but also with the public sector. And I think when it comes to the public sector and governments, the homework they have to do to actually bring adaptation finance to scale is not only looking at specific adaptation projects. Don't get me wrong, we need that. But I think we need physical climate risk considerations, adaptation and resilience metrics integrated into every financial transaction and decision made. And let me give you an example why that matters. If you are building a hydropower station that are actually increasingly vulnerable to climate change, we will have to integrate and understand what physical climate risk actually mean to the performance of that asset. So that's why I think governments need to get that right and actually require financial institutions to not only report on these aspects, but to strategically integrate them. And I think I'm going to speak another truth. We know that there are immense policy uncertainties on the Western side of the world. And I think that's an opportunity for the Asia-Pacific region to become a leading force for private investments into adaptation. And I think one of the points I want to mention is that governments have to stop subsidizing adaptation adverse activities, and that includes degradation of forest and maritime regions, because nature is a free super absorber of risks. So we have to start working with that more. So not only investing into adaptation, but stop investing in adaptation adverse activities. And I think Motsomi has mentioned a lot of the points that governments have to do. They have to engage with the private sector and create a platform. They have to start understanding the language of the private sector. So how do vulnerabilities actually translate into expected loss, into materiality risks, etc. And I think this quantification and operationalization of resilience and adaptation metrics into economic terms is really, really critical. And then I'm also going to mention taxonomies. Taxonomies are standards, and for everyone who doesn't know what a taxonomy is, they basically list the perils and the exposure, specific activities that address these perils, and also indicators how to measure an increase of adaptation resilience. And I think every country needs these taxonomies, and there's been amazing progress from the Climate Bonds initiative on that. And I'm going to quickly also mention what we have done with government. So we, for example, worked with the government of Colombia on tax incentives. And the government of Colombia is currently working on a tax break for companies and financial institutions that invest into adaptation and resilience in the infrastructure and energy sector. And I think that's what we have to do across all sectors. And we have to develop a spectrum of solutions, from grant-based solutions to semi-commercially viable to commercially viable solutions. And I'll stop there because I spoke for a while. But thank you. Back to you.
That was fantastic, Sabrina, and on point as always. I think I want to sort of come back to that point that you raised about, there could be sort of opportunities for leadership in Asian markets. And I think there are some sort of really good examples that we're seeing in the Asian markets as well that I would be keen to sort of get Eric to maybe talk about a bit more in terms of how institutional investors are playing a big role in integrating adaptation into investment strategies, and examples that we're seeing on financial instruments as well in these markets.
Sorry, I was stuck on mute. But yeah, I think really good points from Sabrina, and on some of the examples, I think one that I would point people to is some of the information that's come out of work collaboration between investors and policymakers in Japan. So we've been fortunate enough to be a part of that, and particularly with the environmental ministry, they've put out some really good kind of guidance in terms of kind of adding detail into the NAP and how investors can get involved. As far as other examples and ways that investors can get involved, the CISL report also breaks down the kind of investment process into a number of different stages, and provides some examples on what can be done at each of those stages. So we provided an example on some work that we do at the kind of post-investment stage of corporate engagement and working with a particular company on their scenario analysis and flood defense. Another stage that's mentioned is kind of the risk management and ongoing portfolio monitoring. We've also incorporated a lot of physical risk metrics into that part of our process in the way that Sabrina described. One other example that's a little bit different is from Invesco. So we recently invited Invesco to co-chair the AIGCC working group with us, and they've launched a private fund that focuses on blended finance in adaptation specifically. So I think there's a number of good examples out there, and I would, if people are interested in more detail, I would just point to the two reports, because we made a point of kind of being sure that we had case studies and examples. So there's plenty more good kind of reference material there.
Yes, fantastic. And I think just on one of Sabrina's point on the need for governments to speak the finance language to be able to engage with the private sector better, I think that's such a crucial point that sort of needs a lot more sort of work. I think it sort of really depends maybe on interministerial coordination as well. Like, so as Eric mentioned, in a lot of markets, we're engaging with the ministries of environment, but encouraging them to actually bring in the finance departments as well into these discussions, so you can think about different frameworks to attract capital. But I just also want to turn to Erwin, because I feel like asset owners play a big role in sort of ensuring that mandate for adaptation investments and sort of setting the agenda on why these investments need to happen. So I wonder if you can share a few perspectives on sort of the investment mandates and how asset owners can play a big role in this space as well.
Yeah, okay, give it a shot. So it's kind of combining a lot of things which have already been said, right? So, but, okay, now a couple of very, I'm just going to be very specific, and these are just examples. So there are a truckload of other ones which are kind of similar. So what we've been seeing in terms, for example, of how to solve this whole ticket size thing, right? Because as an institutional investor, you don't want to go after every deal yourself. So what you do is you're looking for funds. Now, what we see is there are a lot of kind of funds that have been set up over the last, let's say, 5 to 10 years, which are really focusing, for example, on emerging markets and on climate-related strategies, right? A couple of them that I mean, for example, ILX is a famous one here in the Netherlands, because it has been set up by a couple of pension funds, right? Other solutions that we have where we actually start building pools in the Netherlands together with the Dutch Development Bank, which is the FMO, which doesn't invest anything in the Netherlands, but they're all in I think it's especially Asia and Africa. So these are kind of also ways of kind of channeling money and directing money to basically solutions, right? And since these are systemic solutions, doesn't really matter where you're doing it, right? I mean, it's even better to go places where you can get more kind of solution for a euro, right? So that's how we end up in those kind of solutions. That's an interesting. So you need an ecosystem, right? And part of the ecosystem has to be the government, right? Because you get all the red tape. That can be very can be a huge barrier, but can also help you, right? So that's also a reason why basically I think there's a nice role for local development banks, national development banks, right, or regional development banks to help get the money and the paper and all the rules and all everything aligned. Because at the end of the day, we're all paying already now today the costs of climate change, biodiversity loss. Not something that's going to be there somewhere in the future, like next generation or whatever. Après nous le déluge, something like that. No, it's kind of happening today. So and these kind of solutions can definitely help get money there. And like I said, I mean, a lot of these constructions, if you look at them, they get you returns which are also very acceptable. You get high yield fixed income or emerging market credits kind of returns and even a little bit less of risk depending on how you look at it. But it is interesting. So it's there. People just have to do their homework and especially challenge their own kind of assumptions, right?
Fantastic.
With that regard. Yeah. Sorry. Yeah.
Yeah, thank you for all of the questions that are coming in, and I think Eric and Trisha, you're sort of trying to answer some of these questions as well. So I'm hoping everyone can see the answers. But Trisha, I just wanted to check if you want to come in with any questions, because I think we just have 6 minutes left.
Yes, sure. And maybe I can bring up one of the questions from the chat as well, where it speaks about the role of public-private partnerships. And this is something that Motsomi, you had mentioned in your opening remarks as well, where it would be good to get your perspective on how to align incentives for public-private partnerships, especially in the context of adaptation finance, where the context is very hyper-local. And so how do you manage that sort of local impact versus international partnerships sort of balance? And also what kind of sort of incentives would be helpful in creating these sort of public-private partnerships?
Yeah, thanks very much, Sabrina. I think this also boils down to a very important question in adaptation, which is how do we get the financing to the local level of the persons that need it? And in most cases, we're looking at small businesses or even smallholder farmers. How do we make sure that? So some of the things that are working and some governments are starting to test out is localized financing systems, like localized insurance or index-based insurances. And there are countries that are testing that, whereby you have localized insurance that the smallholders or small businesses pay little premiums, and then that are able to issue payouts immediately and directly to the people without a lot of bureaucracy that involves even the national level mechanisms. That is working in a few countries. For instance, I have an example also from Kenya, for instance. I'm sorry it's not from this market, but these are some of the instruments that are already working. Some countries are also establishing national lending systems, and these are getting wider and wider now. We have a lot of governments that now have national climate funds or climate change funds that are able to bridge this divide and start to enable. And in these national climate funds, you find that they actually encourage projects or programs that engage the diversity of stakeholders at the national level, engage in the private and the public sector as well. So that's where you find also emergence of the public-private partnerships that have this foundation where they can start from and start to develop projects. And I also just wanted to add one small point. I think in terms of the private sector, where I think it's also proving very important, I think involving them in the decision-making. Sabrina mentioned a very important point on coordination. I think that's very important as well, because we need the private sector language and perspective into the whole process. And by the time we have that, then you have that smooth integration into the whole process. Thank you.
Fantastic. Unfortunately, I think it's time to sort of close, and I'd like to just go around with the panelists to sort of look at, from your perspective, what is one key action that would accelerate this conversation of adaptation in the Asian context. So maybe we can start with Sabrina and then go around.
I think the point was already made, but I would say engage with your clients if you are an institutional investor and try to get as much quantitative but also qualitative information as possible from them on physical climate risks, adaptation, and resilience.
Great. Erwin?
There we go, sorry. Yeah, I think it's I don't know the Asian situation as well as you guys do, but I think it's the same all over the place. The solution is not the problem. I mean, solutions are out there. You just have to do your homework, and you gotta start talking to people and thinking in terms of solutions. And because they are there, the examples are there.
Fantastic. Eric?
Sure. I think the biggest thing that would accelerate kind of adaptation for us as asset managers is really a clear mandate from asset owners. I can't underscore how kind of helpful that can be. I would also echo the point on kind of collaboration with government and policymakers, and really the point that Motsomi just made of involving investors in the planning and doing that early in the process. But it's easy to kind of point the fingers at others and say what asset owners could do or governments could do. And so for asset managers, I think it's, I would agree with Sabrina. I think it's engaging with the companies. We have much better NAPs now than we did 5 years ago. And so kind of bridging between the country level and the corporate level through investors engaging with companies and encouraging that quantification and planning for kind of worst case scenarios is I think the time is now, and there's a lot of really good work that can be done there.
Fantastic. I think that's a great note to sort of close the discussion on. I'm assuming that everyone that's joined the panel discussion today is someone that's interested in working on the topic. So I think you've also sort of interacted with a number of people and institutions that's sort of working in this space. So please do reach out and let's keep the conversation ongoing. And I hope that the insights from this discussion has been helpful for everyone that's made the time to join this discussion. Really appreciate all of the panelists' insights and time as well to sort of engage on the topic. And as I said, we will continue to host more discussions around this and keep the conversation going. Thank you so much.
Thank you.
Thank
Thank
you.
you.
Thank you very much. Have a good day and afternoon.